Welcome, friend and future deep dweller. I thought about information as a very important idea or concept for Deeponomics to dig deeper into. So it comes up in many areas of finance, economics, and accounting. Of course, we talk about information flows. We worry about misinformation. We assume that people act on information. But what is it really? What do we mean when we say information? I wanted to see what happens if we slow down and take that question seriously. So what can we find if we look at some deeper academic perspectives on information? What does the theory say? And can it help us think differently? Okay, so let us start by talking about the theory of information as it is usually defined in a technical or formal way. One of the most famous and foundational thinkers here is Claude Shannon, who worked at Bell Labs in the 1940s. So Shannon came up with what is now called information theory, and even though he was mainly focused on how to send messages through wires without distortion, his ideas have ended up shaping how we think about information more broadly. Okay, in Shannon's view, information is something very specific. It is about reducing uncertainty. I'm going to say that again. It is about reducing uncertainty. The more uncertain you are about what a message will say, the more information it contains when it arrives. So if I tell you something you already know, that does not really add any information. But if I tell you something surprising, something you did not expect, then that message contains more information. Okay, so this is the key idea. Information is not about meaning or truth at this stage. It is about how much surprise or uncertainty gets resolved. So Shannon came up with a way to measure this using the concept of entropy, not in the physical or energy sense, but as a way of describing how many different possible outcomes there are. The more options there are, the more uncertainty and the more information you get when you find out what actually happened. Okay, but this kind of definition does not care about whether the information is useful or meaningful. It is not about the content of the message, but about how many other things it could have been. So if I send you a very noisy random message, that might technically contain a lot of information according to Shannon's definition, even if it's just gibberish. That is important to notice. So in this version of information theory, what counts is unpredictability, not meaning. This theory is incredibly powerful and underpins things like the internet and digital communication. But we need more if we want to understand information in the context of finance or accounting, where meaning and usefulness are crucial. This led me to think about how we often use the word information in everyday language. We usually mean something that is useful or helps us understand something. Not just any message, but a message that makes sense to us and perhaps changes how we think. And that brought me to another way of thinking about information, which comes from philosophy and systems theory. Here we find something called the DIKW model, so data, information, knowledge, and wisdom. Okay, so before continuing, we need to make sure we understand each part of that. So data is just raw numbers or facts, symbols that represent something but do not mean anything by themselves. Information is when that data is processed or organized in a way that answers a question or gives us context. Knowledge is what happens when we internalize that information and know how to apply it. And wisdom is the ability to make good judgments using knowledge. So you can think of it like this. Data tells us what is. Information tells us what it means. Knowledge tells us how to use it, and wisdom helps us decide whether and when to act. I find this really helpful when thinking about finance. So a financial statement is obviously full of numbers, which is data. An analysis of what those numbers show about companies' performance is information. And knowing how to compare it to other companies or spot a red flag is knowledge. And deciding whether to buy the stock based on a mix of numbers, context, and goals, that might be wisdom. just as an example to illustrate the components. But even this does not fully get at what information is. And that question kept bothering me. I kept coming back to the idea that information is always about reducing uncertainty. But in relation to investment decision making, what investors are reacting to is the change in what they know, right? So if information is not just something that exists out there, it is something that makes a difference, something that moves us from one state of knowledge to another. That shift, that change in uncertainty, that is where information lives. So I started thinking about how finance actually depends on information to function. In fact, you could say the entire financial system is built to process information. Prices move because of new information, at least that is an assumption, right? And accounting exists to turn raw business activity into structured information that others can use. Auditors, analysts, regulators, markets, they all rely on the assumption that information is circulating, that it can be trusted, and that it is reducing uncertainty for someone. If that system breaks down, if the information is false, manipulated, or hidden, then the system does not work as intended. That made me realize something simple but powerful. A lot of what we call financial infrastructure is really information infrastructure. Stock exchanges, financial reports, credit ratings, quarterly earnings calls, they are all ways of producing, sharing, and reacting to information. If that flow is clear and honest, it builds trust and allows coordination. If it is polluted or blocked, it creates confusion and risk. And I want to briefly mention that there is another layer we have not touched on yet. It is the sociological perspective, the idea that information is not just about data and uncertainty, but also about power. Who controls information? Who gets to speak? Who gets access? And who interprets? These are all crucial questions. We will definitely explore that perspective more deeply in the future, but for now I want to stay focused on what information is at a basic level as a concept. So what is information? Well, it is the thing that reduces our uncertainty. It helps us make sense of the world. And in systems like finance, where decisions happen under uncertainty all the time, information is not just helpful, it is essential. It is the oxygen of the system. And maybe by understanding it more deeply, we can start to ask better questions about how we use it, how we structure it, and how we know whether it is helping or hurting us. And by we, I mean you and me. I mean any market participating actor, stakeholder, or curious observer. Information is a resource that affects us all, and we should all try to understand what it is and its meaning for us as decision makers operating under uncertainty. I want to leave you with this though, because here is something that made me pause. If information is supposed to be so important, if it is the thing that reduces uncertainty and moves markets, then why does it so often seem to fail to explain some of the biggest price changes that we see? For example, a study by researcher and author named Fair looked at sudden 5-minute movements in the S&P 500 futures market and found that in 90% of cases, he could not link them to any identifiable piece of news or information. Similarly, a study by researcher Siegel looked at huge daily moves in the Dow Jones Industrial Average over more than a century and found that 3/4 of them had no obvious connection to political or economic events. It's not just about indexes either. So Bouchard, and I apologize for most likely butchering that name, he and his colleagues showed that individual stock price jumps also rarely correspond to any new public information, but really in the absence of new information. Even after corporate surprises or market-wide shocks, the price impact of information is often short-lived, rarely lasting beyond a day or two. So what this seems to suggest is that the connection between information and price is not as tight or as causal as we might intuitively assume. So markets move, yes, but not always because new information arrives. So this does not mean information is not important. Of course not. But it does mean we should be careful about overestimating its power to explain or predict what markets actually do. And this made me wonder, if markets move without any new information, then what are they reacting to? It challenges the idea that price changes are always about news or knowledge. Maybe we need to look elsewhere. Maybe the story's more complex. I'm not sure, but it feels like a question worth sitting with a little longer. If you enjoyed this episode, please subscribe. And you can find me on Instagram, Substack, and YouTube. Same name everywhere, Deeponomics. Or you can check out my website, deeponomics.com. There you'll find all my socials as well. If you want to reach out, please do. You can email me at info@deeponomics.com or send me a DM on Instagram. Thanks for listening, and until next time, stay curious.